various doubts in the mind of our friends who all are participating in today's program. And even this kind of webinars will be available later on the YouTube or other way, so that there will be more and more information dissemination. So kudos to you for organizing this wonderful webinar on a regular basis. Friends, as far as the corporate tax is concerned, though we are already into the regime at the level of a UAE, but still there are many queries, or I will say the doubts are there in the mind of our professional colleagues, assessees, and the various other stakeholders. Friends, if we talk about the corporate tax, you are aware that the corporate tax starts that what are the various applicable rates, and um, I will say that what kind of things are there in the corporate tax, starting with the Article 2 and 3. And then, my dear friends, the Article 4 to 10 in the corporate tax deals with the various exempted activities. So in case you are dealing in a particular activity which is falling under the Article 4 to 10, then you are not supposed to you are not supposed to pay the corporate tax at all. Then, my dear friend, the Article 11 to Article 17 deal with the various type of taxable person and how the corporate tax base is there. So what is state source income? Meaning thereby, if you are earning certain income, even if you are not located in UAE, but the income is sourcing from UAE, then that is called the state source income. Similarly, if you have a permanent establishment in UAE, or you are acting as a partner in the unincorporated partnership, or a family foundations are there. So all these provisions are dealing that how the taxability will be there. Then, my dear friend, a very important provision is there in the corporate tax vis-a-vis the free zone person. Because you are aware that in case you are located in free zone, then not only you are not supposed to pay the corporate tax, but at the same time, there are many restrictions and I will say the conditions you have to follow. For example, when you are living in the free zone, but your main activity is linked with the mainland, then there is a problem. What kind of activities which are allowed in the free zone and which activities are not allowed in the free zone is something which is there in the Article 18-19 of the corporate tax law. Then, my dear friend, if we are okay with this, that okay, I am a taxable person, my activity is taxable, and then how I will be calculating my taxable income and what kind of exempt incomes are there. So that is also being defined and given under Article 20 to 25. Then the various kind of reliefs, the deductions are there in the corporate tax. Now, my dear friend, a specific topic which I am speaking many occasions is something about the transaction with the related party or the connected person. That if you are dealing with a related party, whether the transaction price or the whatever the transaction value which you have chosen will be subject to the corporate tax, or any additional or deductions will be there into that. That is something the arm length price calculation which will be required to calculate. So, my dear friend, the Article 34 to 36 deal with that aspect. Then, my dear friends, if there are the earlier year losses, normally we know them as a set off or the carry forward losses. Here in the UAE corporate tax, this is something similar to the tax loss provision. And then the very unique provisions which are there in the UAE corporate tax is tax group. So in case you are different entities are there where the more than a particular percentage of a holding is there, say 95% holding is there, then they can create a tax group with certain conditions. And what kind of a credit, what kind of a set-off can be there, how you can carry forward your losses or something like that, is something is being defined under the tax group provision. Finally, how the corporate tax, the calculation of the corporate tax as a computation is there. And then in case some refund is there, or the registration and the deregistration provisions are also there in the corporate tax. Last but not the least, I will say that apart from the filing of return or the penalty provisions, there is a one very, very important provision which is I wish to highlight here, is about the anti-abuse rules, which talks about that in case you are doing something which is not commercially a legitimate transaction, then the anti-abuse rules will be there. Provisions are there which can make you liable to pay the penalties, or even the harsh kind of I will say the provisions can get attracted as well. So, my dear friend, this was overview that okay, what is all about the corporate tax, and I believe that with the experts available with us in the Chirag ji and Nishan ji, I believe that Jui ji they will be able to answer many such questions of our colleagues who will be raising in today's webinar. So, with this, over to you, Jui ji. Maybe you can start taking the questions of our queries who have already submitted their query, and I believe they will be submitting the queries with the passage of time when the answers they will be getting from our experts. Over to you.
Thank you so much, sir, for such kind words and enlightening us on the UAE corporate tax as a whole. And yes, we have more than 300 registrations and we have received approximately 90 to 100 questions as well. So we have grouped those questions in different categories. And I would like to introduce the other two speakers, C. Nishant Rama sir and C. Chirag Gupta sir. And sir, if you want, I can start taking the questions one by one. So my first question would be for CA Nishant Raima, sir. Good evening, sir.
Sir, you are on the mute, Nishanji. Chiragji, you are also on the mute.
Good evening, Joyji.
Good evening, sir. Sir, the first question is for you actually. One of our candidates have asked. The question is, what is qualifying free zone person and what is qualifying activities? Please explain with supporting and reference to the UAE corporate tax law.
Okay. So I went through, yes, there are more than 92 questions and 50% questions are on the free zone as expected. This is a very burning issue over here, and accordingly, there were two decision, cabinet decision 55 and minister decision 139. Then Federal Tax Authority issued the public consultation document. And after that, they repeal the all decisions. Now, cabinet decision number 100 and minister decision number 265. So I can see here the questions are based on both. So what I can do in a short time, I can try to cover up all the provision related to the free zone person. Now, since the question is, please explain with the supporting of the law and ministerial decision reference. So let me first give the brief about the law. Article number 18 of the corporate tax law provides 6 conditions which need to be satisfied to be a qualified person. So here, first question is, what is the qualified free zone person? So any free zone business which is located in a free zone need to satisfy 6 conditions of Article 18. The first condition is the substance. So basically, we have a ESR also here. But what they are saying that you need to have a substance within the free zone, or you can outsource the substance to the other related party who is also located in the same free zone. Now, substance in reference to the substance means you cannot have a paper company. You have to have a proper office, adequate qualified staff. In this decision, they have added full-time staff. So that way, you have to have full-time staff within the free zone. Second condition is TP compliance, transfer pricing compliance. So if you want to be a free zone person, then you have to comply with all the regulation of transfer pricing. Third condition is that such business need to undertake qualifying activities and earn the qualifying income. Qualifying activities are mentioned in Ministerial Decision 265. There are 13 activities, 4 activities related to the trading of good, 8 related to the various services, and 1 related to the investment. So total is the 13 activities. If any free zone person undertake any of this activity and earn income, then it will satisfy one of the condition. Then the fourth condition is that you have not elected for the normal corporate tax regime. It means you have not elected to be subject to 9%. There are 2 more conditions which is coming from the Ministerial Decision 265. One is the audit. such business need to undergo audit of the financial statement and de minimis requirement, which is up to 5% or 5 million, you can have a income from non-qualifying activity. So in nutshell, if you satisfy these conditions, then you will be regarded as a qualified free zone person. Now, normally, as a layman, people had a concept that if I am a free zone person, means my business or my entity located in a free zone and I'm exporting goods or services outside of the free zone, outside of the UAE, then automatically I will get a 0% corporate tax regime, which is not the true. It means if you are in a free zone and if you are undertaking those 13, any of those 13 activities and earning the income, then only you will be eligible to get a 0% corporate tax regime. If you are doing any business with other free zone, then again any income from such activity will be subject to 0% corporate tax regime. Now, very important to understand, suppose in any particular year you are not able to satisfy this condition, then for coming 4 years you will not be eligible for the 0% corporate tax regime. It means this is the block of 5 years. If you are not eligible for any 1 year, then subsequent 4 years also you will be taxable at the rate of 9%. Once you are not a qualified free zone person, it means you are a normal business. You have to calculate the taxable income and pay the 9% corporate tax on your entire income. Now, many of the people ask the question, we went to the question that whether my company is located in DMCC, free zone, and I'm undertaking the trading activity, whether I will be eligible for the 0% corporate tax. DMCC, see, this related to the one activity which is the distribution activities. As per Ministerial Decision 265, if a business who is undertaking distribution activities within the designated zone, if the goods are imported, then such goods need to be imported through the designated zone. And if the goods are exported, then such good need to be exported within the designated zone. Actually, in UAE, we have somewhere around 45 free zone. Out of this, only 24 are designated as a designated free zone. Now, this designated free zone concept is under the VAT value added tax. There is a one law, law number 8 of 2017, lists down 24 free zone as a designated zone. So if you undertake the distribution activity within any of this designated zone, and if you are importing or exporting the goods for the resale purpose, this is also very important. So it should be B2B, resale purpose. If you are doing B2C or for the consumption purpose, then again you will not be eligible for the 0% corporate tax regime. Now again we have some question on high C or third port sale. It means if I am undertaking the like I am located in a free zone, whether designated or otherwise, and I am undertaking distribution services in such a way that my seat is directly going to the customer. In the sense, suppose I'm in the UAE and I'm buying from the India and selling it to say Kuwait, then my shipment is directly going from India to Kuwait. It's called high sea sales or it's called third port sale. In such case, whether I will be eligible for the 0% corporate tax regime or not. So again, law is not clear on that, but before the ministerial decision 265 and cabinet decision 100, that it means before 3rd of November, there was a one document called public consultation document in which they have specifically mentioned that any high C sales will be eligible for the 0% corporate tax. So based on this, our view, in our opinion, if such activity is conducted from the free zone, then you will get benefit of the 0% corporate tax. There are certain excluded activities. If you are undertaking any of such activities, then those income from those activity will be liable to pay the 9% tax. Again, there are now in this Ministerial Decision 265, they have added one more activity, which is a qualifying activity called qualifying commodities. Now, this will also serve the purpose for the DMCC, some of the businesses located in DMCC, and they are indulging into the trading of the qualifying activities, qualifying commodities. Now, these commodities is specifically mentioned in the ministerial decision. If you are trading into the metal, minerals, or any agricultural commodities that traded on a recognized stock exchange, then any income from such activity, irrespective whether you are in a designated zone or any other free zone, like if your business is located in a DMCC, which is not a designated zone, yet you will be eligible for the 0% corporate tax. So a lot of people say that what is the qualifying commodities? That it's only mentioned like a metal, mineral, agriculture commodities. Same like gold bar, silver bar, or minerals like a natural gas, crude oil, coal. This all commodities, if it is traded in a raw form, and if it is traded on a recognized stock exchange, then those income from those activity will be regarded as qualifying activities, and income will be subject to 0% corporate tax. So this will cover up entire provisions of the free zone person. Over to you, Joyji.
Thank you so much, sir. You have given answer to one of the most and very popular important question on free zone. Now, I will direct my next question to CA Chirag Gupta, sir. And again, it's a very important topic, registrations. So the question is, sir, is there any deadline or threshold for corporate tax registration? And if the company already has VAT registration, then do they have to need to do it again?
Yes, Vijay. So again, one of the valid questions, but I would say not one question, actually it's 3, 4 different questions you have combined into one. So I would take each aspect one by one in order to simplify it. So first question is, what is the deadline for registration? So the deadline depends upon the financial of the company. If you talk about financial year, generally it is a 12-month period of any company. Generally, the financial year is mentioned in the incorporation document, which is your memorandum and articles of association, or how generally you are preparing an audit report. Sometimes it may happen that the financial is not mentioned, which is very rare. If it is, then you have to use Jan to December as the financial. So considering Jan to December, a majority of the companies over here in the UAE is following calendar year. So if we go by that, then as per the corporate tax, there's no such deadline, but you have to register before the return filing due date, which is 9 months from end of the financial year. So if you consider Jan to December as the financial year, your deadline for return filing is 30th of September, which is 9 months. But we always recommend all our attendees over here not to wait for the 9-month period. The process is started. If you go to FTA website, they have already option is there for the registration. Start now, because it might be once you submit your application, there might be further questions, queries from the FTA. So it's better you start now and don't wait for the year to end and then you start registering. This is number one. Number two, unlike VAT, there is no such threshold for registration. all the companies, irrespective of free zone company, irrespective of mainland, whether you have transaction, profit, loss, doesn't matter. All the company, irrespective, have to register for the corporate tax. Now, VAT is totally different from corporate tax. Yes, the authority for both VAT and the corporate tax is same, which is Federal Tax Authority, but registration is different because the entire mechanism, entire law is different. So we cannot say that no, if my company is already VAT registered, or if my company is not VAT registered, do I have to register? Yes. In any of the scenario, you have to register for the corporate tax, because unless you register, how authority will come to know, that how much where's the profit, sales, whatever. So registration is mandatory. It doesn't depends upon the threshold. One important element, that I would like to discuss what we face practically. Many times, once we start the registration, we observe that at the time of VAT registration, which was maybe in 2018 when the VAT was introduced, the client or the assessee didn't updated the documents, which is maybe trade license or the passport copies of the owner, which is show expired. So if that is expired, the authority, the application form will not be proceed unless you update the earlier application in VAT. So it's very important that before you start the process, make sure in your VAT everything is updated because it is now linked. The same Imara tax portal which we used for the VAT, the same portal you have to use for the corporate tax. There is no separate portal. So this is what is commendable about the UAE government, that it is making our life easier. Everything is paperless, everything is faceless. There is no physical document is needed to register. And if all is already registered under VAT, it would be very easy, because it has already got your data. But make sure the data which is already captured is updated and is not expired. I hope I was able to cover, Juhiji, all the subset of your question.
Thank you, Chirag sir. Thank you for answering all the 3 sets of questions. Now, my next question would be for CA Dr. Atul Kumar Gupta, sir. Sir, the question from the candidate is, who is related party and as per the corporate tax regime under UAE corporate tax?
Juhiji, as far as the related parties are concerned, just to clarify you that the Article 35 deals with the related party. So who are all the related parties? So just to share with you, there are the 2 categories of person as far as the UAE corporate tax is concerned. One is a natural person and the another is a juridical person, means a person who is registered with the, so it's a legal entity. In a layman language, it will be a legal entity. So in case of a natural person, as defined under the Article 35, up to the 4th degree of kinship or affiliation, including by way of adoption or guardianship, so they are being treated as a related party. So the 2 or more natural person, if they have the relation up to the 4th degree of kinship or affiliation, maybe through the adoption or guardianship, they are the related party. As far as the legal person, that is called the juridical person, is concerned, as we witness at the global level, that if one party or one juridical person or a natural person, as the case may be, controls the other directly or indirectly, and then in that case, they are also the related party. Now, what is directly or indirectly and what is control? Something which we should be discussing and deliberating. Just to share you a ballpark figure, that in case you have the 50% or more, the ownership, so whether you are having a voting right, you have the board control, you have the decision control of more than 50%, in that case, that will be treated as a interest. So you have a beneficial interest or the supervisory interest. So that is something number 1. Number 2, the directly or indirectly. So one way is that the company, say for example, one juridical person is there and that owns the more than 50% of the stake in the another company. So both will be treated as a related party. Now, when we talk about the indirectly, so meaning thereby, say for example, A control B and the B control C. So automatically what will happen? The A will be treated as that they having the control or the relation with the party C in that way. So maybe A and B together, they are controlling C, or the A is controlling A and C is controlling B. So this is the actually the ecosystem wherein if uh, a party A or X is controlling the other with the more than 50% of the ownership interest, or maybe the board, or maybe the voting right, then both will be treated as a related party. Now, since both are related party, they have to take care of many things, which I will be discussing in some other question. Over to you, Joy.
Thank you, sir. Thank you for answering the question. And my next question would again be for Ms. CA Nishant Rama, sir. So the question is, what is the tax grouping under the UAE corporate tax law? Whether an individual can form a tax group?
Thank you, Gigi. Please put your questions in Q&A. I think maximum all questions we answer live. One of our team member will be answering your question. So you can put in the Q&A based on our discussion if you have further question. Now, coming back to your question that what is the requirement for the tax grouping? So I saw 2, 3 more questions on the same, whether natural person can be a part of the tax group, or a individual, a natural person can form a tax group. So it will be advisable to discuss all the conditions for the formation of the tax group for the larger interest of the audience. Article 40 provide that a eligible taxable person can form a tax group. What is the tax group? This tax group is altogether different than the tax group under the VAT. Here, the conditions are different than the VAT. Any eligible person can be a part of the tax group. What is the purpose of the tax group? So that you will have a one return to file, one tax liability, one taxable income, and one tax liability. Plus, you will not require to follow and comply with the transfer pricing documents. You have to follow the arm's length as per the Article 34, but you will not require to maintain the document which is prescribed under Article 55 for the transfer pricing regulation. So basically there are 7 conditions. All the conditions are mandatory, must to be fulfilled to form the tax group. The first condition is only juridical resident person can form a tax group. Now, when we say a juridical person, it means the natural person like you and me cannot form a tax group. Here, especially on this part of world, we know that a person has a more than say 50% shareholding in a several entity, but there is no holding company as such. So in this case, you cannot form the tax group until and unless you create a SPV, special purpose vehicle, which holding company can hold more than 90% shareholding and voting right in all other companies, then only you can form the tax group. So the natural person, individual person cannot form the tax group. Again, same condition is only juridical resident person can form a tax group. It means you have to be a resident company under Article 11 of the UAE Corporate Tax Law. So non-resident person cannot be part of the tax group or cannot form the tax group. Suppose the holding company which is incorporated outside the UAE, such company has say 5 subsidiary over here, that non-resident company will not be cannot become a holding company or cannot become a member of such a tax group. This was the first condition. Second condition, which is again the mandatory condition, is 95% share capital or voting right. So such holding company need to hold 90% or more share capital and voting right. When we say voting right, it means if you are a beneficial owner of such share, then only you can create a tax group. The third condition is such holding company should have 95% of the should be entitled for the 95% of the profit or net asset of such subsidiary. It means holding company when hold 95% of the share capital and voting right, along with it, it should be entitled for the 95% of the profit and net asset of each of the subsidiary which will be the member of the tax group. Then the fourth condition is that such member should not be an exempt person. Exempt person, there are certain businesses given exemption under the UAE corporate tax law. So such businesses cannot be cannot be a holding company or cannot be part of such tax group. Then there are two procedural conditions. One, you need to have a same financial year. It means holding company and all the member of the group need to follow the same financial year and same accounting standard. So suppose you are following International Financial Reporting Standard, which is required to be followed under the UAE corporate tax law. And suppose one member is following US GAAP, then again you cannot form the tax group. And the last condition is that a qualifying person, a qualifying free zone person cannot be a part of tax group. Since qualifying free zone person is eligible for the 0% corporate tax, so such qualifying free zone person cannot be a holding company or cannot be a part of the such tax group. Here the question comes, if such free zone person elected to be taxed at a 9%, in such case, whether such free zone person can be part of a tax group or not. Yes, if the free zone person is elected under Article 19 of the UAE corporate tax law for the regular tax regime, then in such case, such free zone person can be part of the tax group. So many people ask the question that what is the benefit to form the tax group? One, suppose you have a holding company and you have a 10 subsidiary. If you will not form the tax group, then in that case you have to file the 10 separate corporate tax return. So your compliance cost will be high. If you form the tax group, then all 10 entity will be consolidated with the holding company, and holding company will require to file the corporate tax return to work out the taxable income, work out the tax liability, and pay the corporate tax liability and file the corporate tax return. So that will be easier to handle than the multiple entity whereby you have to calculate several income and several tax liability. I hope the answer the question. Over to you, Joey.
Thank you so much, sir, for answering the question. And my next question would be for CA Chirag Gupta, sir. So the question is whether the accounting profit and tax profit be the same.
Yes, so most likely the answer is that it would not be the same because accounts as already covered by the previous speakers that you do accounting as per the IFRS, International Financial Reporting Standards. Over there, some expenses are allowed, some are not allowed. But as per the corporate tax, again, you have to do the method calculation as per the corporate tax. So if you see the Article 28, it covers deductible expenditures. Article 32, entertainment expenditure, and Article 33, non-deductible expenditure. Just to, I cannot cover all the articles. Maybe we can have a separate session on that, but to just give a flavor, like some expenses are non-deductible, Article 33, like fines, penalties, or the illicit payments, these are non-deductible expenditure. Article 32, which covers extensively on the entertainment expenses, what it says that any kind of entertainment expenses may be like meals, accommodation, transportation is only allowed 50% of the total expenditure spent. But there is one exception to it that if you do the entertainment expenditure on the employees, then it is 100% allowed. So what is required over here is, and what we are advising to all is that make your chart of accounts also aligned to the corporate tax. Because next year when you will be filing your return, you won't have to go to each line item and see what expenses are allowed and what are disallowed. Like if you talk about entertainment expenses, like, example, if I give you one case, recently we visited our client, and what we saw that, the accountant was passing the entry for the entertainment expenses. Maybe sometimes it is an office expense, sometimes staff expense, and sometimes miscellaneous expense. There is no such predefined methodology. So in this case, it's very important that you define your accounting processes now, because till now there was no taxation, so it was kind of generally accepted policy by the accountant, and the auditor will also relying on. But now things have to be changed, things have to be aligned as per the tax law. Then similarly, certain expenses, which is majorly transfer pricing, related party transactions, your remuneration to the managers, directors, shareholders, key executive has to be aligned as per transfer pricing. So again, has to be looked at, plus a depreciation policy. So like this, there is n number of expenses, like say dividend. Now dividend income, it may be exempt. So if it is exempt, it would be added back to the deduct to the profit. So again, the profit will change. So definitely the answer is just to one line answer. No, it will not be the same. It would be different, and we need to look your P&L, which out of accounts, to see what expenses has to be added back to the profit. Over to you, Juji.
Thank you, Chirag sir. My next question would be for CA Dr. Atul Kumar Gupta sir. Sir, the question is, what is anti-abuse rule under corporate tax?
Yes, thank you, Juiji. And I believe it's a very, very important aspect you have asked me. The anti-abuse rules, which are there under the Article 50 of the corporate tax, they talk about that in case there is a assessee which is supposed to pay the corporate tax, and they have certain transaction or the arrangements which is not a valid commercial or for the non-fiscal reasons, which reflects the economic reality, meaning thereby that if a assessee is there and they are entering into certain transaction or arrangement to save the tax, actually the transaction is not showing the real economic reality, meaning thereby, say for example, I am normally selling a water bottle for a 1 dirham, but just to save the tax, I'm entering into an arrangement that okay, I will pay the 10 bottles for 1 dirham, which is actually not reflecting the economic reality. And the main purpose of the transaction is to take the corporate tax advantage. Similarly, I can share with you, because my colleagues were discussing about the this free zone vis-a-vis the mainland. Now you are aware that in the free zone area, there is a no tax liability for certain type of transactions, and for certain other conditions are being followed. Now they have the mainland activities also, but just to avoid the tax, they are actually diverting the profit to the free zone entity with certain arrangements which are not prudent arrangements. So in that case also, there will be a kind of a invocation of section Article 50, that is the anti-abuse rules. I can tell you the many other examples like this. For example, we discuss about the tax group. So when you are creating a tax group, but actually the holding which is required at 95% is not there. So you are creating artificially the permanent establishment. So you should have this much of a like a qualifying exemption. One of the question I was looking into the Q&A, that what is this qualifying exemption all about? So if you have the more than the 5% stake, then the qualifying exemption will be available or not is something is there in the law. Now you are trying to create, trying to enter into arrangement that you want to take the advantage, which is not naturally or economically available to you. So, my dear friends, in case we are entering any of such kind of arrangement or the transaction which doesn't have the economic realities, and that is to take the undue tax advantage, then the section 50 talks about the anti-abuse provision, meaning thereby that there will be the just to share with you that what the Article 50 talks about. The Article 50 talks about that the corporate tax advantage, which is actually not supposed to be there, the undue advantage can be like that you are claiming a refund claim, which is not, you are not eligible. You are looking for some kind of avoidance or the reduction of the corporate tax payable, or you want to defer the corporate tax or advancement of the refund, or you want to avoid the obligation to deduct the corporate tax, which is right now 0%, but in case it is required that you have to deduct, but you are not, you are avoiding to deduct that. So in all those cases, what will happen that the Section 50 will be invoked by the authorities, and they may disallow your exemptions, deductions, or the whatever the reliefs are there. They may also uh, uh, re-characterizing your transaction. So what will happen that, say for example, I sold the water bottle, the 10 water bottle for 1 dirham, but actually it is 1 dirham, one bottle. So what they will do, they will say that, okay, I will add up the 9 dirham income into your uh, into your computation of the income, and then the tax calculations will be there. So these kind of provisions are there in the Article 50, and apart from that, there will be the penalty provisions which will be also followed, and like all these things will be there. Now, when there will be the anti-abuse provisions will be invoked by the authorities at any point of time, the article also give the provisions that the assessee will be given an opportunity that they can demonstrate that why these transactions are genuine and legally valid. So that kind of a benefit will be like the opportunity of being heard will also be there into the ecosystem, which is also being given under this Article 50 and sub-article 5 and 6 as being given. So it's very important that the SSCs and all the stakeholders need to take care that they are not uh, characterizing certain transaction in a way that will be deemed that it is something to avoid the tax or take the undue benefits are there. Over to you, Juiji.
Thank you, sir. I believe the questions that have been put in the Q&A box, we are trying to answer all the questions, and we are grouping the questions and we are asking to our speakers. So my next question is for C. Nishant Rama, sir. The question is, sir, is there any limit to pay salaries to owners and partners under the UAE corporate tax law?
Thank you, Luigi. Actually, I was answering the same question. One question I saw: is there any cap on director remuneration to an extent of 10% of net profit? Is this the same or any other question on the same? I saw in the Q&A.
Yes, correct.
Yes.
This is you are one of very hot questions,
All right.
Nishanji.
Yeah, we will cover up this in the light of the Article 36. So, as we all know, the only jurisdiction in the world which has a corporate tax, but there is no personal income tax. And here, more than 70% are SMEs, small and medium enterprises. So, what happened? All those SMEs are closely managed and operated by the owners or relative of the owners. So there was a one big challenge, and this questions, what question we got, I remember I put on the next day on which they announced the corporate tax. Corporate tax was announced on 31st January 2022. On 1st February 2022, I put a question on the online public platform that what will be the manager remuneration, because we were knowing as a tax practitioner, we were knowing that corporate tax is coming, but at the same time we were knowing that there will not be a personal income tax, and this was guarantee given by the federal tax authority. So this question, since then time and again this question was raised, that what will happen if we pay the salaries to the partners, to the owners or shareholders. Since there is no personal income tax, and as I mentioned, maximum of businesses are SMEs, small businesses, and one way or other way, either the owner, shareholder, or partner, or relative of such partners are involved into the business or running the business. So in this case, what will happen? Whatever profit remain, they will motivated to transfer it to shift it to the individual account. Like if I am a owner, I am running the business, and if I am earning a profit, say 1 million, then what I will do, I will put my salary, say 200,000 per month, and that will be a qualifying expenses. So in that case, I can do the very legitimate tax planning. Now to answer this, they come up with one article called Article 36. Any payment to connected person. Connected person is defined as the owner, partner, shareholder, or any related party of such person. And if the business is making any payment, not only salary or any perks or any allowance or any reimbursement expenses to such person, need to be at arm's length. Arm's length in the sense it should be at a fair market value. So to answer the question, that if you are paying the salary to your owner or shareholder, then that need to go through the set procedure. It called functional analysis, whereby you need to see the need benefit analysis. You need to do the need benefit analysis in the sense that whether this business will require the services of that particular person, whether business is getting any benefit out of the services from this person. Suppose any owner coming once in a week to sign the checks and charging the 100,000 salary will not be eligible for such salary. Then you have to have a job description, proper timesheet, and you need to document what kind of services he is providing. Suppose in your business you have a two finance director or CFO, and you designated such person as a finance head, then you may not be eligible for a bigger salary. So need benefit analysis you have to perform. Now one question, that whether there is any cap of 10%. This 10% cap is mentioned in commercial company law of the UAE, whereby the listed company can pay manager remuneration to the manager to the extent of 10% of the net profit. And suppose such businesses are incurring the losses, then to the extent of 200,000, they can pay the salary to the manager person. Now this is the different law, the law of the UAE, but this is not the tax law. So you can take the guide from the such commercial company law, but that will not be a criteria to fix the salary under the UAE corporate tax law. UAE corporate tax law, salary and salary to manager remuneration will be decided as per the provision of the Article 36. In the sense, whatever salary you want to pay in your accounting, you can pay, but to be a tax deductible, you need to perform the functional analysis. You need to do the benchmarking on extra database, and if your salary coming within that range, then that salary will be eligible. Otherwise, any excess salary will be disallowed, and you have to add back to the your taxable income. Many people ask me whether whatever benchmarking salary only to the extent of this we can pay to the our owner, balance we cannot pay. Answer is simple, that yes, you can continue paying the same salary, but for the tax purpose, you have to add back to your taxable income, and you have to pay the 9% tax. So that way you will not require to readjust your salary for your accounting purpose. Then some of the people, they ask the question that we are paying this salary since last 5 years, since last 10 years, still we will not get deduction. So again, irrespective whether you are paying this salary for past 5 years or 10 years, whether before joining or starting your business, you are getting whatever level of the salary, those data may be helpful to work out your salary, but that will not be the criteria for the salary. It can help, as I said, that your past record will help to work out the salary, but otherwise, the provision of Article 36 is very clear that you have to do the functional analysis. Again, is there any cap? No. There is no any cap. Salary, such salary can be 10,000, 100,000 or 1 million per month. It depends upon the profile of the person. So that way, the Federal Tax Authority cannot come out with any sort of the cap. There are certain guidelines under the OECD transfer pricing as well. One can take the reference of guideline. By this time, since last 2 years we are doing, by this time we are crystal clear that what we need to do to get salary deductible from the business. And there is a set procedure which need to be followed by the tax consultant. If the business will not be able to do that, because for that you have to create a proper document, proper agreement, job description, and at the end you have to do the benchmarking on external database. You may need to follow any transfer pricing method, like some of the cases we follow the TNN method, which is very recognized method. So such method you have to follow, and you have to find out what will be the eligible salary range for the particular connected person. I hope that answered the question.
Thank you, sir. We have a lot of questions coming in, and as everybody can see, Nishant sir and Chirag sir are trying to answer it even in the chat box. Having said that, my next question would be for CA Chirag Gupta ji. The question is whether the corporate tax will be applicable on offshore companies.
Yes, the answer is straightforward. Yes, even if the company is offshore, still it is a part of UAE, and UAE federal law is applicable. Hence, corporate tax will be very much applicable. The company has to register for corporate tax, file the return, and pay the tax liability, if any. So yes, corporate tax is applicable on this. Unfortunately, yes, it is applicable.
Thank you, sir. So since we are running short of time, I would quickly come to the next question. This question is for C. Atul Kumar Gupta, sir. Sir, the question is, if company X LLC is giving rent to its owners or directors, whether that also requires to check some things?
Juhiji, I believe that Nishanji has given a detailed reply on this particular aspect. As we discuss about the Article 36, which is actually dealing with a connected person, meaning thereby that if you are giving a payment to a connected person, then you have to see that whether that follows the market conditions, or I will say the right word is that whether that follows the payment which is being given, that follows the market value or not. Now, my dear friends, as the Nishanji already explained to you, that who is a connected person, this is something that we should be aware of. The connected person means the owner of the taxable person, meaning thereby a juridical person is there, and the owner of that is a connected person, or the relative of the related party of that owner will also be a connected person. And the another one is a director or officer of the taxable person, and again a related party of the director or the officer. So meaning thereby it is not only the owner or the director, but even the related party of that owner will also be a connected person. I want to clarify you specifically. That's why I am touching upon that. Say, for example, you are giving the rent to the owner. Now, that should be based on the market value. So if the normal rent is, say, for example, for a property is a 5,000 dirham per month, but you are giving 20,000 dirham per month. So that is not a market value, and then it will be an arm length calculation which will be required. Now, rather than you are giving to the owner, but you are giving a related party of the owner, say, for example, up to the fourth kinship, or the owner is controlling some other company. Say, for example, you are XYZ LLC, where the owner is there and you are paying a 20,000 rent. the XYZ LLC is giving a 20,000 rent as compared to 5,000, not to the owner, but to the ABC LLC, which is also owned by the owner. So in that case, since that ABC LLC is the related party of the owner, and even if you are giving this 20,000 dirham per month as a rent to from the XYZ to ABC, and since that doesn't depict the correct market value, then it will be an arm length calculation which will be required, and that will be falling under the Article 36 as being discussed. So it's very important that we have to have the understanding of what is connected person, and if any payment is being made to the connected person, whether that holds the market value or not. Over to you, Julie.
Thank you, sir.
Verifying that there is a question which I just clicked rather than typed, that somebody was asking, name is not there, that from the that whether they can follow the transfer pricing from 1st of January rather than for the last years. Just as we are aware that we have to prepare a opening financial statement vis-a-vis with the current financial statement, though from whenever they are getting registered with the corporate tax regime, may it be the 1st of July or 1st of January, they can follow the transfer pricing provision from then only. As such, for the earlier period, it is not required, but though they may be preparing an opening balance sheet for a generic purpose. But as such, there is no need to go back and calculate the transfer pricing value for the earlier years.
Thank you, sir. Nishan sir, can we take one more question? I know we are running short of time, but if there is a possibility.
Yes, please go ahead. It's okay.
Sir, the question is again, it's what is the concept of POEM and PE under the UAE corporate tax law? So I'm compiling too many questions in one question so that all the questions can be answered.
Yeah. Thank you, Yogi. This is very like this should be the first question because it requires a lot of time, but it's okay. We can touch upon in the interest of time. One is the poem. It's a place of effective management. And second, you ask for the P, which is the permanent establishment. Let's see what is the provision of the poem under the UAE corporate tax law. Article 11 specifically provide any company which is effectively managed from the UAE will be regarded as a resident person. It means any foreign company, if it is established that such company is getting managed from the UAE, then the status of that foreign company will be same as equal to the company which is established or incorporated within the UAE. It means entire corporate tax regulation will be applicable to such business same as it is applicable to the any UAE company. It means any of such company will require to do the registration under the UAE corporate tax law, pay the tax at the 9% and file the corporate tax return, comply with the transfer pricing regulation. For example, there is a one company in suppose in UK and the directors or board of directors are sitting in the UAE and taking a strategic decision or related to such a company which is incorporated outside UAE, say UK, but those decisions are getting done from the UAE, then this company, which is a UK company, irrespective whether such company is paying the corporate tax in UK or not, but it will be liable to pay the corporate tax in the UAE at a rate of 9%, need to register same like any other UAE company and file the corporate tax return. It is different issue that whether if such company pay the tax in UK, whether such company will get foreign tax credit in UAE or not. Or one need to see the provision of the tax treaty between the UAE and UK. Is there any benefit such business will get under the tax treaty? That will also be the different issue. But plain reading of the Article 11 suggests any business which is getting managed from the UAE, then such business will become a resident. One more very important point, any company incorporated, recognized, or registered within the UAE regulation, such company will be regarded as a resident company. Now, UAE resident company will be liable to pay the tax on worldwide income. So, any company which is a resident company will be subject to the UAE corporate tax law for its worldwide income. The income which is received accrued outside UAE will also be subject to the UAE corporate tax law. Now, this brings us to the understanding that even the company which is incorporated outside UAE, but if it is getting managed from the UAE, then such company will be liable to pay the corporate tax on its worldwide income. It means UK company is earning any income from say USA, then those income also be subject to the UAE corporate tax law. So these provisions are very very different. Poem concept is there, worldwide most litigated concept, but one need to be careful, especially in this jurisdiction, because we were not having a corporate tax, and lot of companies are incorporated outside UAE, and those director or shareholder or managers were sitting in the UAE and deciding all the management level decisions, holding the board meeting in the UAE, which will not be possible now until unless your business is ready to pay the UAE corporate tax. So this was regarding the point. P, permanent establishment. This is also again a most litigated aspect of the corporate tax. This suggests this like in the UAE corporate tax there is a separate article, article 14, which speak about the permanent establishment. So what is the permanent establishment? Suppose a company in the India, I'm little bit going fast in the interest of time. The company in the say one company which is in India and earning the income from the UAE without making the company or branch or any office in the UAE. Suppose they have four people doing the survey, pitching the customer, acquiring the customer, and transferring it to the UAE. In such cases, whatever activity done within from the UAE, and if you earn any income, those income need to be those income will come under the UAE corporate tax. That income will be subject to UAE corporate tax. It means the Indian company will require to pay the tax, the UAE corporate tax on such income, and such income need to attribute to the UAE. It means you are earning 100 million income. Out of this, certain income need to attribute to the UAE, which is accrued or arise from the UAE, and you need to pay the corporate tax to the UAE. This is also a very different provision. It's not a straightforward provision, so one need to be very careful, especially when a foreign company, whether such company is in India or UK or USA, and those company has branches over here, and they are conducting the business, then you need to be careful. It shouldn't happen that P trigger. If permanent establishment trigger, then whatever income of such P along with any income which is flowing to the headquarter will also be subject to the UAE corporate tax law. Now this was the scenario before, since there was no corporate tax. Lot of people, they open the offices or liaison office or certain offices without incorporating the company, without making the any legal entity over here. In those cases, now this is the right time to restructure in such a way. Either you have to have a company, because when you will have a company, then only the income of such company will be taxable in UAE. But if it is a P, then there will be a attribution of the profit flowing to the headquarter, which is very cumbersome exercise. I hope that answered the question.
Thank you so much, sir, for answering the question in a very short and crisp way. We still have a lot of questions to answer, but I'll still like to take one last question. And I'll ask this question to CA Chirag Gupta, sir. So the question is, my company's formed on 10th June 2023, and my financial year ending is Jan to December. So what will be my first financial year?
Yes, Joiji. I would keep the answer very quick. Since the company was formed on 10th of June, financial year is Jan to December. So as per the UAE commercial company law and IFRS, the first financial year should be of minimum 6 months. So the considering that your first financial year would be from 10th of June 23 to 31st December 23, it means you have already ended your tax period and you have to file your corporate tax return before 30th of September 2024. So I hope you have already started your registration because the year has already ended. So I wish you that any questions you have, you may further reach out to us or the Texo. There were further questions also in the chat, which I was seeing that if they need further assistance on corporate tax update, how they can get more knowledge. I think Juhij, you can touch on that question, how they can get in touch with us.
Sure, sir. Sir, Texo has its own UAE corporate tax software wherein we share the regular updates and all the judgments and all the notifications we share. And I also like to apprise that we are going to start a fourth UAE corporate tax course very soon in the month of March. And the questions that have been asked in the chat box and in the query section earlier, majorly they were on the free zone and PE and POM and registrations. We are touching all the important and relevant questions that have been asked today. If you need deep knowledge of all these topics, this is going to be a 6-day program with 12 hours of live trainings, 12 hours of classes with Q&A sessions in the end. So I would like everybody to kindly register for themselves. I'll share the details of the UAE corporate tax, Texo, and the course details with all the participants. With this, I would like to end today's sessions. It was a pleasure and an honor to have all the esteemed all the esteemed guests, CA Dr. Atul Kumar Gupta sir, CA Nishant Rama sir, and CA Chirag Gupta sir, and all the participants for joining us today. And it was an honor and a privilege to answer all your queries. You all have a lovely weekend. Thank you so much. Thank you so much, sir.